What if you could fill out some forms online, sign a few documents, and get a discount on your monthly student loan payments? Today I'll be discussing how it's possible and whether or not you should do it. Hello and welcome to Practical Personal Finance. My name is Andrew Shear, and this is where I give you the information you need to understand and succeed with money. Today I'm going to be discussing refinancing your student loans. If you have student loans, then give this video a thumbs up. First, I'll be telling you about the purpose and process of refinancing. Then you'll learn about the pros and cons of refinancing both federal and private student loans in the current economic environment. Make sure you stick around until the end, when I'll give you my recommendation for what actions you should take with your specific loans right now. If you're new here, don't be shy. Hit that subscribe button and join the conversation in the comments below. There's been a lot of talk recently about low interest rates and refinancing debt, especially student debt. Chances are you've seen or heard it mentioned at least once in the past few weeks or months, and if you've got student loans, you may have even considered it. What does it actually mean to refinance your student loans? What's the point of refinancing? And most importantly, should you refinance? We'll start by going over what refinancing is. If you have a loan, refinancing is the process of transferring that loan to a new lender. Here's how it works. Let's say you have a loan from lender A in the amount of $20,000, and you want to refinance that loan. You talk to a new lender, lender B, and they agree to do the refinancing for you. Lender B pays lender A $20,000 on your behalf. Your loan has now been refinanced, and it's with lender B. If you're not already familiar with refinancing, you may be wondering, why go through all that trouble? The answer is quite simple. Your new loan with lender B will typically either have lower monthly payments or a lower interest rate. This could help in a number of ways. If your monthly budget is really tight and you can't afford your bills, refinancing could get you a longer term and lower monthly payments. If you're looking to save money and your current loan is costing you an arm and a leg in interest charges, refinancing could get you a lower interest rate so that you'll pay less in interest over the loan term. And if you've got a loan from a lender you don't like, refinancing could allow you to cut ties with them. With the pandemic trashing the economy and causing interest rates on new loans to drop significantly, you might be in one of those situations. If so, it could be beneficial for you to refinance your student loans. The most popular reason for refinancing is securing a lower interest rate, so that's primarily what I'm going to talk about in this video. When refinancing in order to lock in a lower interest rate, there are 3 factors you need to pay attention to. These factors will help you determine if you'll save enough money to make refinancing worthwhile. They are your credit score, the difference between your current interest rate and the new interest rate, and how quickly you plan to pay the loan in full. Let's go over each of those factors one by one. Then I'll help you apply what you learned to the 2 main types of student loans, federal and private. First is your credit score. Your credit score is important whenever you take out a loan, and it's very important when you're refinancing a loan. The reason your credit score is important is that when you're refinancing, you want to secure the lowest interest rate possible. And the higher your credit score is, the more likely it is that you'll get that minimum interest rate. If you don't know what your credit score is, I made a video about how you can check on it for free online in just a few minutes, and I'll leave a link in the description. Most lenders are going to look at your FICO credit score when evaluating your loan application. In general, you want your FICO score to be above 660 and ideally above 780 in order to qualify for the best possible terms. If your credit score has improved since you took out the original loan, you're probably in good shape. If your score isn't quite there, don't worry. There are some credit score hacks to help you get your score up quick. I made another video where I share all the details, and I'll leave a link to that one in the description as well. The second factor you need to consider is the difference between the interest rate on your current loan and the interest rate you're offered on the new loan. If there's a major difference in interest rates, you could see some major savings every month and over the life of the loan. But if the interest rates are nearly identical, it might not be worth the hassle to continue and go through with the refinance. For example, if you had a loan for $10,000 with an interest rate of 10%, the interest alone would cost you $1,000 per year. If you could refinance that loan and secure a 3% interest rate, the annual interest cost would be just $300. In that case, you could be saving up to $700 per year, and it's probably worthwhile to refinance. But if you're only able to secure a 9% interest rate by refinancing, your annual interest cost would be $900, and you would only be saving $100 per year at most. With all the hassle you need to go through to get the new loan, the minimal savings might not be worth it. An easy way to calculate your annual savings is by subtracting the new interest rate from your current interest rate and calculating the interest on the difference. If you want to go into more detail about this type of calculation, I made another video about how to calculate interest on a loan, and I'll leave a link in the description. The third and final factor is the amount of time it's going to take you to pay the loan in full. This plays a big role in the amount of money you're going to save in the long run by refinancing. If you're going to be paying a loan for a long time, like 10 or 15 years, refinancing and securing a lower interest rate, even if it's just a slight decrease, is more likely to provide you with substantial savings. On the other hand, if you're planning to pay a loan in full in just 3 to 6 months, even a large interest rate cut might not make it worth your time. For example, let's say I have a loan of $10,000 and the interest rate is 7%. I want to know how much interest I'll pay if I pay the loan in full in 6 months versus if it took me 6 years. For this calculation, I'm going to use a simple loan calculator I found on bankrate.com. If I input my loan information and select 6 months, I can see that I'll pay about $205 in interest. Now let's try 6 years. With the longer term, I'll be paying a lot more interest fees, about $2,275. If I'm paying this loan off in 6 months, I can save a maximum of $205 by refinancing. And that's if I somehow manage to get the interest rate down to 0%. We know that's not going to happen. But if it's going to take me 6 years to pay off this loan and I could cut the interest rate in half, I stand to save over $1,000. With that kind of savings, you've got my attention. Now that you know the 3 factors to be conscious of, let's take a look at the 2 main types of student loans, federal and private, to help you decide if now is the time for a refi. When you're thinking about refinancing student loans, it's important to keep in mind the type of loans you're refinancing, because different loans have different rules and benefits attached to them. Let's start with federal student loans. These are student loans that you might have received from the federal government. If you aren't sure whether your student loans are federal, you can check by logging into your account on the studentaid.gov website. When you log in, it'll tell you what your federal student loan balance is, among other things. Your federal student loans have some very important benefits attached to them, especially at the time of this recording, during the coronavirus pandemic. There are 3 that you should absolutely keep in mind. First is that these federal loans are eligible for special payment programs like income-based repayment. Private loans are usually not eligible for programs like this. Second is that these federal student loans should be completely on pause right now, until at least September 30th, 2020. There should be no payments due, and the interest rate should be 0%. And finally, there is the possibility of loan forgiveness. There are a lot of different loan forgiveness proposals being tossed around right now. If you're interested in learning more about what could happen after the 2020 election, I made a video about that too, and I'll leave a link in the description. For the most part, these benefits do not extend to private student loans. For private loans, there are typically no repayment plans that change based on your income. There could be some relief options due to the pandemic, but none that are federally mandated, and none as generous as those afforded to federal student loan borrowers. And getting private student loans canceled or forgiven is extremely unlikely to happen. All that being said, here's my advice, and I'll keep it simple. If you have federal student loans, at least right now, you should not be refinancing them. In fact, I wouldn't even think of refinancing federal student loans anytime in the next 12 months. Yes, the interest rates are low, but they're going to stay low for quite some time, until the economy recovers. You're not going to miss out on low interest rates. You're never going to get a better deal than the 0% interest rate the federal government is providing right now. And there's a decent chance you could see some federal student loan forgiveness after the November election. If you have private student loans, you should be looking at refinancing immediately, especially if your credit score and income have gone up since you originally took out those loans. There's a high chance you could secure a lower interest rate and save thousands, if not tens of thousands of dollars, depending on how long it'll take you to pay your loans in full. Interest rates are probably some of the lowest you're ever going to see. It doesn't make sense to wait around for them to drop even more. When you refinance, make sure you go with a fixed interest rate only and not a variable interest rate. If you're not sure about the difference, I made yet another video on this topic as well, and that link, you guessed it, is in the description with the others. I've personally had a positive experience refinancing and consolidating some of my student loans with SoFi. Although they are in no way affiliated with me or this video, I recommend them if you're looking to refinance your student loans. If you'd like to give them a try, I'll leave my own unique SoFi referral link in the description of this video. If you use my link and end up going through with the refinance, you'll get a $300 welcome bonus from SoFi, and I'll get $300 too. Will you be taking advantage of the record low interest rates and refinancing your student loans? Let me know in the comments. If this video was helpful, give it a thumbs up. And please consider supporting my channel by becoming a subscriber with notifications turned on. Thanks for watching. I'm Andrew Scheer, and I'll see you next time.